Bismillahirrahmanirrahim. It's a pleasure to have this opportunity to speak on Islamic finance at this occasion. In 2012, a gathering of the most well-known fuqaha and Muslim economists in Kuala Lumpur issued a declaration called the Kuala Lumpur Declaration on Islamic Finance. And this particular declaration announces the fact that from the perspective of both the fiqh and the knowledge and science of Islamic finance, the essence of Islamic finance is sharing the risk between the entrepreneurs that have investment projects and the people who provide the financing of investment projects. And it declared that not only the essence of Islamic finance is risk sharing, but that encouraged, in fact, the declaration uses the word must, that it says that it recommends that the governments of Islamic countries must adopt risk sharing as the fundamental of the policy structure. So perhaps we could start and explain what is risk sharing. Every society faces a certain amount of risk. These are external and domestic risks, both with respect to the society as a whole and with respect to economic and financial risk. And so each society and each individual within it have three options of managing this risk. This is in general, three options, and there are no more. The three options are risk transfer and risk shifting, and finally risk sharing. So risk transfer is basically when someone transfers the risk of finance and economics that they face to other individuals. We do that when we deposit our financial resources at any bank. We transfer the risks to the bank. The bank, in turn, transfers that risk to the borrowers of the bank. So it serves as a financial intermediary, intermediating between the surplus fund holders and the investors. Consequently, they basically are in between the surplus finance holders and the deficit finance holders. Risk shifting is when two sides of a financial contract they shift the risk from themselves to a third party that may or may not know that these two parts of a financial contract are shifting the risk to it. The prime example of this kind of risk shifting is when, as a result of crisis, before the crisis actually hit, shifts of risk to financial institutions happened when the risk was shifted to a third party, which is the taxpayers of the countries which were in crisis. Basically what that meant was that individual financial institutions became rich as a result of their actions, while the taxpayers of the country were forced to pay the cost of these risks that these financial institutions were taking. So that is risk shifting. Risk sharing is when people, both on an individual and a government and the society level, decide to share the risks of finance and economic transactions. So this happens in many instances. For example, mutual insurance, which is basically when a group of people get together and decide each of them to contribute to organizing a insurance company where each individual, according to their ability, contribute to the financial structure of, let's say, an insurance company. And there is provision that when and if risks materializes in case of any individual, they tap into these resources. And so basically it's a mutual support institution. Takaful, which is Islamic insurance, is basically operating on the basis of mutual sharing of the risks to the individual members of a takaful company. So risk sharing then in essence is what Islamic finance is all about. Because of the fact that risk transfer is not an acceptable form, the reason is that basically Islam requires that no earnings should accrue to holders of financial resources unless the holders have actually taken risk with their resources. So there is a maxim, for example, al-gharmu bil-gharm, there is no reward without participation in the risk of a project, no reward from the project without participation in the risk of that project. So basically then it has to be that those people who participate in a particular economic or financial project each have to take a part of the risk of that project according to their ability to actually take those risks. Now, from the point of view of risk sharing, everybody in the society, including the government of the society, will have to participate in taking and sharing the risk. Governments should and have to, especially in Muslim countries, have to share the risks with their people because they are representatives of it, or allow risk to be shared through the institutional arrangements of the country. So itself, the government does some of this risk sharing. For example, when they tax their people, they're sharing the risk with their people in a way that when and if, let's say, an economy goes into recession, their revenue declines, as would the income of participants in the economy during recession. So consequently, they do share, partly they share the risk. Examples of risk-sharing arrangements, we said the governments share risk through taxation, but also government provides a certain amount of expenditure to the people whose income ability is too low for them to sustain themselves. So in a way, governments share the risk of lower income groups. They become the intermediaries between the rich and the poor. They tax the rich to transfer funds to the poor. So that's also another example of risk sharing. In terms of private sector, you have cooperatives. Cooperatives essentially do the same thing. They share the risk among the members of the cooperative group. For instance, if you have the producer cooperatives, they produce, let's say, agricultural product. Farm cooperatives are very well known. So basically, they take the products of their groups and they provide the mutual support after the sale of the product in the market, and they share the revenues among the producers according to what each producer has contributed to the final product that has been brought to the market. Some people suggest that Islamic finance is not about risk sharing, but about profit-loss sharing. There is a misunderstanding here because if you talk about profit and loss, both these concepts relate to post-production and post-sale. You first have to produce or get a project to come to the final fruition, then you take it to the market, you earn the revenue, and then you check to see whether you have a profit or loss, and you share profit and loss. This is called an ex-post process, meaning that it comes after a production process or investment projects come to an end. At that point, the result of that, whether loss or whether gain, will be then shared among the project participants. The problem with saying that Islam is all about profit and loss and not about risk sharing is that there is a misunderstanding about what risk means and what projects means. The fact is, before a project starts going to final destination or a product is produced to be brought to the market, there has to be some arrangement at the beginning about how they're going to risk the share. For example, when you get to the end of the process and you're about to let's say, share the profit or losses, you have to know in what proportion you are going to divide it among the participants of the project. But how do you know how to divide it? The division, the share, the parameter of sharing has to have been decided at the beginning of the process. But at the beginning of the process, no one had any idea what happens to the project because time is involved and market is involved. So many things can happen during the process. This sharing parameter has to be decided at the beginning of the process. And because you don't know what happens in the future, you're facing risk and uncertainty. That parameter that is decided before, let's say, a mudaraba contract or a musharaka contract has to be decided at the beginning of the process. This process is called ex ante, that is before the process of production or investment project actually goes into operation. The share parameters have to be decided at the beginning. And because at the beginning there is uncertainty and risk about the process, this has to be risk sharing. So risk sharing is an ex ante process, whereas profit loss sharing is ex post. So they are both a concept that relate to one another on a one-to-one correspondence. So you cannot talk about profit and loss sharing without knowing what the arrangement for risk sharing was. So consequently, after consideration, the members of both the fuqaha, the religious scholars, Sharia scholars, and the Muslim economists decided that in the declaration, Kuala Lumpur Declaration, they decided that the essence of Islamic finance is risk sharing and not profit loss sharing, because once you decide the risk sharing arrangement, profit loss arrangements are already known ahead of time. But what is crucial here is that knowing that the essence of Islamic finance is about risk sharing, then the organization of Islamic banking and Islamic financial institutions and organization of financial policies and economic policies of the government that has to be based on risk sharing in a Muslim country. So the problem is that many of fuqaha as well as financial experts would rather have an Islamic financial structure that on the surface rejects interest mechanism, but when they want to have financial contracts, the benchmark to those contracts become interest rate, which is LIBOR. And so basically, Islamic finance becomes a different version, perhaps only an asset class within the conventional system, but it is not Islamic. Because the litmus test of Islamic finance is how much does it help poverty, how much does it help equalizing income distribution, not making them equal, but making them equalize them in a sense that you do not have this huge differential between the rich and the poor. That is the litmus test of Islamic finance, aside from other things, but these are the central aspects of Islamic finance. And we see that doesn't happen. In fact, a recent study at INCEIF for a PhD done by Dr. Ala Al-Abid shows that virtually in all OIC countries where Islamic finance operate, it's not only its risk transfer, it's worse, it's risk shifting. So risk sharing is not becoming an operational apparatus within the Islamic financial structure. But why is that? Basically, a contract which is based on interest rate, that is debt contract, is called an impossible exchange. Impossible exchange because when I loan money to somebody, there is an incentive built into this structure of contract that should let's say a borrower decide, they can basically default. They can default. So in order to stop this default, the governments have many policies. Of course, they need a big government, a big police, big courts, a lot of lawyers, in order to make sure that people who borrow money fight against this incentive to default. If I loan somebody money, there is no incentive for them to pay it back. Therefore, it's called an impossible exchange. To make that exchange possible, governments have to come in to enforce the contract, and if somebody doesn't pay, they end up in jail, or at least in courts, and they have to put up with an enormous amount of expenses of fighting the court system. So governments actually use tax money in order to enforce contracts which basically the borrowers have no incentive to perform. So there is a subsidy for creditors within every system that has interest rate based debt system in it, or conventional finance, actually subsidizes the rich against the poor. So against the poor, which means those people who don't have enough resources to either invest or consume the products that are available to them and they need. So in order for Islamic finance to work, governments have huge responsibility to actually level the playing field between risk sharing and risk transfer, between conventional finance, which operates on the basis of interest rate, and Islamic finance, which has to operate on the basis of risk sharing. So far, no Islamic government has been willing to do that. Secondly, Islamic governments have to start their own financial and economic policies, not based on interest rate. In every Muslim country, the monetary policy is based on interest rate, so is the fiscal policy. Every Muslim government borrows in international markets based on debt contracts, which is un-Islamic. So we cannot see a way forward for expansion of Islamic finance unless governments are willing to step up and level the playing field. We are not suggesting that they should outlaw, because it doesn't work, that they should order an issue that there should be, all the banking system should be based on Islamic precepts, on risk sharing, because it has happened here, where the government declared that that banking system should become Islamic. It's happened in Iran. No other Muslim country has actually issued edicts that the Islamic system, that all the banking system should become Islamic. In both of these countries, it hasn't worked. So you cannot force people. So what we are saying is that you do not need to force people if you make sure there is no tax advantages, no subsidies for an interest rate-based debt system. All you have to do is to ensure that the playing field is level, so either provide the same advantages to risk sharing as you would to risk transfer, or alternatively, make sure that at least the borrower is protected as much as the creditor is. That, let's say, a stockholder, a shareholder in the stock market is as much advantaged as somebody who has money and loans up, as a rentier, let's say somebody who basically is a creditor. And what is unique about this conference is that for the first time you actually have explicit addressing this idea of risk sharing as the essence of Islamic finance. I wish them all the success.